Welcome back, everyone, to another episode of Insightful Principles. On today's episode, I have a special guest here on the show. Her name is Deepa Reddy Akula. Did I say that correct?
Yes.
Okay.
Yeah.
Yeah, and we definitely do have a special show here for you all. We're going to talk about multifamily real estate through syndication. And Deepa, welcome to the show. I'm glad we got a chance to set this up.
Oh, thanks, Kevin. I'm so happy to be here.
Yes, yes. And I actually heard about Deepa through another podcast I listened to by Rod Cliff, Lifetime Cash Flow through real estate investing. And I really just enjoy listening to your perspective with your background in mechanical and aerospace engineering. You gave a lot of great advice on how people can be able to get into real estate, utilizing the concept around syndication and just the importance of adding value. And that's what we're going to talk about throughout today's episode. And I really wanted to take some time to just learn more about syndication, learning more from you, as well as hearing your perspective on how you became a successful multifamily investor. But to get things started, would you mind just sharing a little bit more about your background and also about your real estate journey?
Sure. So, I have a bachelor's in mechanical engineering and from India, and I really wanted to learn about machining and different materials. So, got into mechanical and aerospace engineering at University of Missouri, and lo and behold, Boeing was active. They have a facility in St. Louis. So they were working with the professors at University of Missouri, and my advisor was one of those people that was working, and I was researching different materials, different aluminum alloys that could make the heat affected zone smaller for the aircrafts when they fly, and just extending the life of the aircraft. And Boeing paid for my entire master's. I got a free ride, and I was working under a PhD candidate, and there were bachelor students that were researching under my supervision at that time. And all of us assumed we were going to just work for Boeing. And I did not know that after the 9/11 attacks, Boeing was not hiring foreign-born engineers for their facilities where they had defense contracts going on. And St. Louis was one of those facilities. So I couldn't get into Boeing to work. Now I had to and I graduated in during the Great Recession, 2007, and it was very difficult to find jobs. And the first job I found was in civil engineering, and I took it. You know, jobs were hard to come, and I um, designed telecommunication structures and utility structures. Kevin, are you driving? As you drive down the road, you see many structures on the road, that carry electricity, that are cell phone towers or radio towers, or there are many structures that are hidden too. They're called monopoles, and they hide. If you see a pole that's really, really big for what it's used for, like it has a flag on it, but it's really thick, um, we hide cell phone antennas inside them and put a shield on them and make it look like a fact. So there are a lot of structures that are hidden too, that are repurposed to make it look like they're doing something else, but they're, cell phone towers. So worked on a lot of those monopalms, monopines. We have poles that have pine fronds on them. So anyway, I designed like about 10,000 structures that are in service right now in US and Canada. And as I was in civil engineering, we moved to Seattle, and I was always interested in real estate. So that's what I did during my downtime is browse through houses, not physically, but on the browser, on Redfin and Zillow, and that used to just calm me. I used to, that's how I spent my time. So, and that I just by doing that, I knew when the prices went down, what was a good deal, and things like that. So my love for real estate and my love for financial freedom, got me reading more and more. I'm an avid reader, and I stumbled into the concept of syndications. And that I took a few years to learn really everything about syndications before I started to invest as a limited partner. And after investing as a limited partner for a few years, I got tapped on the shoulder to be a general partner. And now I'm in Arizona, Texas, and Florida, and a limited partner in about 1,800 units, and a general partner in about 1,400. The doors keep on changing as we exit and enter other properties, but for now, those are the numbers.
Yeah, and that's amazing. When I was looking at your background, I could imagine it probably was a new transition for you, coming from aerospace engineering, mechanical engineering, and doing more structural things. I recall listening on Rod Cliff's podcast how you talked about you were going from doing design structures with airplanes and cars, and now you're thinking about just the engineering structural aspects of just like homes and different buildings, commercial property. So I could only imagine it was a different transition, but I just really love how while you were a civil engineer, you were looking at creative ways of creating financial freedom. And that's what this channel was about, financial literacy. I think that it's important to think about ways of if you are working a 9 to 5, nothing is never guaranteed. And you want to make sure that you're creating some cash flow and streams of income outside of your main source of income with your career. So I wanted to transition this conversation on if you could take a moment to really explain what syndication is and why it's a great strategy when becoming a passive investor with real estate.
Sure, yeah. So real estate is has always been a great investment strategy, and it's as old as the earth itself, as long as we humans started to figure out, hey, we can own this plot of property. There've been always renters, leasers. So if you want exposure to real estate and don't want the hassles of being a landlord, passively investing in a syndication is a good start. And what a syndication is just a group of people coming together, pooling their resources, their experience, their capital. Capital is a resource, all the resources together to acquire an asset that they would not be able to acquire by themselves, just individually. And to give you an idea, in some of the syndications, we have 400 people, 500 people. So all of us, all of limited partners, pool our resources together, and the general partners are also part of the syndication. And what the general partners are bringing to the table in a syndication is their experience, because to run a 300, 400 unit apartment complex, you really need experience of running other properties or working under an experienced investor. Just be an apprentice. You need to have some kind of exposure. If you've never managed anything and if you're thrown on in the deep end, it's very difficult. And the lenders, the bank who actually lends most of the money to buy these properties, they want somebody that is very experienced. They won't really lend to anybody that's just going to run the property down into the ground. So they have the biggest stake to lose. So GPs bring their experience to the table, and some properties cost north of $100 million, and somebody has to sign on those loans. They're loan guarantors, and the GPs sign on the loans as well if they have the net worth. So it's all the LPs that are limited partners that just write a check for 50, 100, whatever, $1,000. And all the general partners, they invest their money too. You always want to invest in a syndication where the GPs are putting some money down as well. And they're also bringing their experience to the table.
Yeah, and that's a great explanation. And I actually wanted to get your perspective on just how you got started as a limited partner and finding your first syndication property. I know that you said it took you 2 years, before you actually was able to find that opportunity? And if you could kind of explain the differences between a limited and a general partner, maybe some people may not know exactly what roles they have in the syndication. So if you could explain that as well, that would be great.
Sure. So in a syndication, a limited partner is somebody that writes a check, wants to invest, wants some exposure of real estate in their portfolio and want to invest, but does not has another job, has disposable money that's sitting around in the bank that they want to invest, but don't want the hassle of running the property. So that person writes a check and or in this world wires the funds to the syndication's bank account. So and that's where the responsibility ends. The limited partner takes a look at the general partners. I'm going to get to what a general partner is, but they takes a look at the team. They take a look at the team and the property and the market. And do you trust that team? Do they know what they're doing? Do you like the market? Do you like the property? Then you invest. You just wire funds and bam, you're invested. You're a limited partner. A general partner is more on the active side of things. They are looking for the property. They're on the acquisition side and they're running the property, which means they're on the asset management side. They are talking to all the investors. You could think about 400, 500 people trying to invest 500, sorry, 50,000, 100,000, even $1 million. All these 400 people are trying to invest, and somebody has to manage those investors and communication and all those things. So there's investor relations people involved, and disposition, they're underwriters. Underwriters make sure that the deal is good. So all these people that are actively involved in finding, underwriting, running the asset, and disposing of the asset and managing the investor relations. All of these people are general partners. They're actively involved in running the syndication. So that's the difference between LP and GP. So LP is limited partner, GP is general partner. And sorry, what was the other question, Kevin? You had another
Yeah.
question.
Yeah. And what was your steps during that 2 year process when you were trying to become a limited partner? What exactly was you doing in that time to position yourself to be a part of a syndicated real estate deal?
Oh, yeah, thank you. So I started lending money to a flipper, to a hard money lender. Sorry, I was a hard money lender. Sorry, I lent money to a flipper. And that money came back in 6 months, I believe. And the return was about 8%. I was trying to help out a friend. And that's kind of how I got started lending money and investing in real estate. So that's both, right? You're lending money to a flipper and also investing in the real estate because that money, the property is collateralized when you lend um, to flippers. So I was like, oh, this is interesting. And I was already always interested in real estate, like I said. So, but that aside, I never really put two and two together in my mind where um, I'm interested in real estate and financial freedom and all the other things they just didn't click. So I was reading a 4-hour work week, I believe, that was written by Tim Ferriss. And I'm usually just listening to books while I'm gardening, cooking, whatever, as long as my child is not home. I don't want to ignore him. So when he's home, all the headphones and earbuds come off. But when I'm by myself cooking or walking, I'm just listening to books. And I heard Tim's book, and it was a really big book, but he talks about so many different ways of coming up with making a living with just working 4 hours. And when I heard this book, I was working about 50 hours. I was head of engineering, or rather, I was not head of engineering. At that point, I believe I was engineering manager, and I was managing a team of engineers and project managers, and it was just busy. And I'm a licensed professional civil structural engineer too. At that time, when I was practicing, I was licensed to practice structural engineering in 9 different states. So, with that kind of responsibility, structural engineers have a lot of responsibility with design and oversight of other engineers. It was just getting too much, and I couldn't see the end in sight, meaning, I'm just working and just trading my time for money, and we only have so much time. So that book kind of um, started the wheels turning in my mind, and started to look for different opportunities of started to educate myself. I was like, what is financial literacy? What's money? And I read Rich Dad Poor Dad at the same around that time. Then he talks about syndications too. He's Robert Kiyosaki. He's heavily invested in syndication. So I did some research on him. So I just went and educated myself as much as I could. Actually, Robert Kiyosaki had their a boot camp or something in Tacoma, and I used to work in Tacoma at that time. So I went to that boot camp and just listened to their pitch and just studied what they had to say. And what was the other thing that I did in those 2 years? There was a boot camp that I took for 3 days, I believe. It was RE Mentor, David Lindahl. Their boot camp is a 3-day boot camp, Friday, Saturday, Sunday kind of thing. I took Friday off from work and put the little one in daycare and just hightailed it to Bellevue for this boot camp. And they gave me the basics of it was a 3-day boot camp, but they have a bigger program, which I'm mostly self-educated for the most part in civil engineering and in real estate. So I took all the basics, and they gave really good information and books, materials. So came back and read through those materials a few times, like 3 times. In those books, everything is underlined. I'm like, okay, if everything is underlined, nothing's important. But again, I read it so many times, I was like, oh, I think this is important. Anyway, all my books are like that. I just underline everything because I read them like few times, and at different times I find different things interesting or important. Anyway, but I just studied, went to town on those materials, and tried to teach my husband about it. Or, when you talk to people or try to talk to others and explain it to others, no matter who that is, they have questions, and you just hearing yourself, you're like, oh, why is that? It just does something different if you vocalize, verbalize. So I tried to like get my husband's attention and sat him down on the dining table and tried to teach him everything in that book. And, just by learning. And I've learned about syndication. Now my problem was at that point, I've learned about syndications, but most of the syndications at that point, or at least the ones that I knew, were 506B. And if it's a 506B, it is a SEC regulation, you guys, for anybody that's listening. There, it's a regulation D 506B. What that means is you could only raise capital from people that you already know, that you have a substantial relationship with. And I did not know anyone that was in syndication world. This was in 2016 or so. And I just started reaching out, and the friend that was in real estate at that time, who was a flipper, she gave me the contact information to another person and said, hey, this person, I think she's in multifamily. I'm not vouching that she's good, but she's in multifamily. Just reach out, do your own research. And that's kind of how I got in contact with a general partner. And she had a deal going on, and that fell through. So that didn't close. The first deal did not close. So that gave me the opportunity to get my mind ready. Like I was going to invest. I really dug deep into that investment opportunity. Like I was really going to write a check for 50,000, but I never did. Like the deal didn't close. So now I had this rehearsal, and when the second deal that she got to the market actually closed, and I invested in that one.
That's good. Yeah, I'm. It's really just encouraging to hear just your process and how you really took the time to self educate yourself and you reinvested into yourself. And that's one thing that I think is vitally important when you are trying to find an investment vehicle. You're trying to find better ways to not exchange your time for money, but have your money work for you in different ways. And I think Robert Kiyosaki, I listen to him a lot. And one thing that I've read of his that really stuck with me is the cash flow quadrant, where he talks about you have the B and the S on the left side, which is a business owner, self-employed, and then on the right hand side you have an investor, and then you also have so it's a business owner, investor on the right hand side, and the left hand side is actually employee and self-employed. And he's really saying how those on the left, they exchange time for money, but on the right, they have either a team of people working for them, especially like in a syndicated deal. Everyone is collectively putting in, I guess you could say, sweat equity, or being able to create value amongst each other to be able to bring more equity into the property. And I think that it's just great to hear your journey and how you were able to leverage and start from hard money lending and being able to eventually grow into other areas. But I did want to get your perspective on, as well as when it comes to limited partners and general partners. I know when I was preparing for this conversation, I was reading online how you have about over 2,300 apartment units. And to my understanding, limited partners are only liable to the amount that they contribute into the deal. So if they're putting in 50,000, they are liable to the amount of money that they're putting into the real estate deal. But general partners tend to have more responsibility. They also assume full liability, so it tends to be a little bit more on their shoulders when it comes to just the equity and also the other things associated with their responsibilities. But can you kind of talk to me about your process of how you manage risk and due diligence when it comes to the different aspects of analyzing syndicated deals?
You're right, Kevin. So the limited partners, they are only liable. What's invested in the deal is what they tend to lose if the deal doesn't perform or goes south. But for um, the general partners have earnest money in the deal, and they are loan guarantors. They've signed on the loan, and usually they don't get paid until all the investors get paid. So there's a 70-30 split. So they've all these upfront costs because the general partners have to fly to the property, and relative to how much the property is worth, a flight ticket is not worth a lot. But there's due diligence that has to happen, and there's a lot of front-end time and money invested for the general partners to even bring a deal to the limited partners. And there were so many things, so many properties that we look at that we might not even bring to the limited partners. So there's a lot of cost involved to be a general partner and liability because we sign on the loans, and usually we get paid on the back end when the property sells. And because of the profit, 70-30 split, 70% of the profits goes to the limited partners, and the 30%, every profit dollar, usually this is the split, but different GPs might have different split, but um, that's just the generic split. And the way LPs want to invest in deals is to see how conservative the general partners are. Are the general partners conservative? You need to ask questions as to, hey, what happens in this scenario? What happens if there are a lot of companies? If some of them close down, can you still find renters? Can you still find residents? What happens if the interest rate goes up? That's very relevant to what's happening today. And just different scenarios, and listen. As a limited partner, if you're starting to think of investing as a limited partner, you'll have to just listen to different podcasts. 506B deals are not public, so unless you get into a deal, you don't know what's going on behind the scene. SEC regulates that, and hopefully all the GPs are following it. And we can't really advertise the returns or anything about a 506B deal on social platforms. That is soliciting. So you want to get in touch with a general partner, ask them to walk you through, and that's doing two things at the same time. The general partner is getting to know you, so they can check off the substantial relationship with the limited partner. And the limited partner is trying to gauge to see how the general partner is answering questions. So, as a general partner, um, And as an engineer, I want a big safety margin. So um, we are looking at, I'm going to go top down. We're looking at the market to see how many employers are in the area and how the population growth has been in the past 10 years, how the job growth has been in the past 10 years, and how many properties are coming online. So when we're trying to run this property, if we're trying to lease it up or change the resident base, are we going to run into competition? So newer properties, sometimes to lease it up, to get residents, newer properties will provide deals saying, hey, half a month off or whatever. So we don't want to be competing with better properties or newer properties like Class A that were just completed. We don't want to be competing with them unless there are competition. But um, we don't want to be at the same rent range as new properties. Even if I was a renter and I have a 5-year-old property and a brand new property offering the same rent, I would go to the new property, right? So you want to see what the demand is that's in the pipeline. This you can find out by talking to the city and figuring that out with the permits and all. So that's the market. You want to see if they're renters and if those renters have jobs to pay the rent, and if we have a steady stream of renters coming into the market, and if the state overall has population that's increasing. We don't want to be in a state where the population is decreasing. That means at some point it's going to catch up to the property and there won't be enough renters, then the occupancy is going to be low. So that is the market. And for the property itself, it has to, in my opinion, this is purely my opinion, I work on properties that has at least 150 units. I think that gives me a good 2.0 margin of having good cash flow, and the property can support its own staff. Um, Somebody that is on there at the property at all times, a community manager or a property manager that's on site, a leasing officer, and 2 or 3 maintenance technicians. Some general partners say they can get it to work with 80, and I'm sure we can get it to work with 80, but that is really, um, that doesn't have a cushion, and I want a cushion. So I try not to work on properties that are less than 150 units. I have worked on properties that are less than 150 units before, and that's purely because we had a sister property right next door and 3 minutes away, and we were sharing resources with them. We were sharing payroll and staff, and that is my reasoning for not working with smaller properties. Relatively smaller properties is because they don't have economies of scale. But if they're sister properties, then that goes out the window because we do have economies of scale because there are other properties that we own that are nearby. Um, so that's the number of units and the mix. How is the mix of the units? Meaning, is it how many 2 bedrooms versus 1 bedroom and 3 bedroom does the property have? And the vintage, meaning how old the property is. The older properties take a little bit more TLC for them to run. There's a little bit more on the maintenance side because they're older properties, just like older homes. Um, so the vintage of the property and the underwriting. So that's all at the property level. And on the books, on the underwriting side, I would like to have the property to have at least 1.75 debt service coverage ratio. What that means in simple terms, if the property is, let's say, generating $100,000 per month, sorry, let's say the property owes $100,000 in mortgage per month. That's a very high number, but the reason I'm using that number is for simple math. I want the property to generate $175,000 in revenue. So what the property owes to the lender versus mortgage versus what the property is making. I want a good cushion over there too. So look at the debt service coverage ratio, and those are all the things that I look at when going into a property.
Yeah, that's really good. It sounds to me, location is very important, and like you said, population growth. Looking at the occupancy rate, perhaps, and like you said, with the debt to service ratio. I think that those are all vital metrics that an investor needs to look at when they're doing due diligence and managing risk. And I think I've heard you talk about this also as well on other podcasts, kind of looking at the PPM, the private placement memorandum, which it may touch on a lot of the things that you're talking about. But can you kind of touch on that as far as how important it is to take the time? I know Rod Cliff said it's a document that not too many people want to read. But what have your experiences been for reading a PPM, and what do you tend to look for? Is it those main metrics that you're looking for inside of a PPM?
Those are all great questions. So I highly doubt the SCR will be in the PPM unless because it's really the PPM is private placement memorandum, and that's what it stands for. And it is the legal document, contract between a limited partner and the property. It just says I invested $50,000 or $100,000 in this particular property, and I have this property, the PPM to show for it. So that's the contract between, a limited partner and the property and the general partners. So the PPM just lays out, um, actually, it just pretty much everything that can go wrong. What happens if something goes wrong? What happens if a general partner passes away? It has information like that in there as well. It can be all encompassing, but the things that I look for, the first couple of ppms, I would request all the listeners to read through them. Just get some good strong coffee and read ppm, because it's a very boring document. There's a lot of boilerplate that the legal team sticks in there. So if you are new uh, to investing in syndications, please read through the first one or two PPMs that you are planning on investing in. And it has the team, and it talks about how many GPs and who all are part of the team. And usually it also has the pitch deck, the presentation that the general partners present during introduction of a property to their investor base. That's also legally binding. That's also in there. The GPs can't just say anything in those, even in their pitch decks. Well, GPs are not supposed to say anything at any time, only the truth. But the pitch deck is also legally binding. It's part of the PPM, and it also has the main thing that as an LP, if I was an LP, what I would be interested in is when the property makes money, how is it split? And who gets paid first? Usually it's the lender, the mortgage. We have to pay the mortgage first. But once the mortgage is paid, how is the rest of the money split and distributed is what I want to see. And you know, when are the distributions? Is it quarterly, monthly? Some in different classes of investment has different cadence of distributions. So you might want to read through that, look for that, and as LP, I would only be interested in returns. So those would be the things that I would look for.
Yeah, that's good. And that definitely is one thing that I'm going to pay attention to, as I start my journey when it comes to syndication. Now, I wanted to kind of just get your opinion on everything that we're seeing right now in the economy. We're dealing with, recessionary fears, with, just higher interest rates. We're seeing that economic growth is going down over the last few quarters of 2022. And I wanted to get your perspective around how have you been kind of preparing for these different market conditions, what we're experiencing right now with Vinside Capital, and also how does one kind of prepare themselves in a recession? I know cash flow is probably one thing that's very important, but what have your experiences been in your business with these current market conditions, and how does one prepare uh, if they're looking to get into this industry, if they're already in this industry when it comes to just recessions?
That's a great question. But we have to be, as general partners, we have to be ready for these market cycles, because we can't start to dig a well when we get thirsty, so we have to anticipate. And as this was kind of happening, we kind of knew in 2021 that the rates were going to go up this year. So what we did was we had rate caps. We have purchased rate caps for all the properties that had floating loans, floating interest rates with bridge loans on them. I know I used a lot of words that are like high level, but I'm going to go through every one of them. So a bridge loan is where private lenders come in and they lend the money. They have millions of dollars sitting on the sidelines and they come in and they invest in this property. Usually, when we go to buy a house, we go to regular banks, right? Like Chase or Bank of America, or the banks that lend us money. But for commercial, um, Freddie and Fannie are also good lenders, but they're very, very conservative. And if a deal does not fall under their criteria, usually in 2021 and before, all the GPs went to a bridge loan. So this is private lenders. Their risk tolerance is a little bit higher, but the catch is the interest rate is floating. You never know how much you're going to pay in mortgage. As the interest rates were going up, we saw $40,000, the mortgage go up $40,000 on one property in 1 month. But these are really big properties, Kevin. Like it wouldn't happen on a smaller property. Um, but that's the catch that have because they're lending on a riskier. It's not riskier, but their risk tolerance is higher. But they want to get paid for lending to these properties. So that is a bridge loan. And what a bridge loan is exactly how it sounds. It's a bridge between when the GPs are trying to stabilize the property, meaning get the occupancy up. Stabilized property is where the occupancy is higher and it's running on cruise control. So as a GPs try to get the property to stabilize, and in between the property being qualified to get an agency loan, meaning Fannie or Freddie loan. This bridge loan bridges the gap. That's pretty much what a bridge loan is. It bridges the gap where it lends money and they want to get paid for that higher risk. And for the bridge loans, because the interest rate is floating, we want to get an insurance so that we have a max for where we can um, stop the interest rates from going up for ourselves. So that is the rate cap. The rate cap is an interest rate cap. So if we got a loan and the rate cap was for 50 basis points, meaning half a percentage, 0.50%, then if the interest rate goes up 25 basis points, which is 0.25%, we still have to pay that. But if it goes up and beyond what the rate cap is, the insurer, the person from or the institution from whom we bought the rate cap, they pay the difference. So it's just like health insurance, where if you max out of pocket, the insurance starts to kick in. That's kind of how you have a rate cap, and once you hit the rate cap or the interest rate goes up a certain point, the insurance kind of kicks in, the rate cap kind of kicks in, and they pay you so that your exposure stops there. And no matter how high the rate cap, the interest rates go, um, your interest rate is still where you bought, that's the rate cap. So we had rate caps, we bought rate caps on all the properties that we acquired last year. And even in the beginning of this year, we have rate caps on all of them. They're expensive, and on one of them, it was about $2.1 million, 2.1. And we have to see, okay, if the interest rate, the Federal Reserve is saying that the interest rate is going to go up so many times by so many percentage points, and we calculate all of that and say, um, is it cheaper for us and do we have better insurance and underwriting if we buy the rate cap? Is the $2.1 million worth spending right now for something that's going to happen in the future? And it was totally worth it. Right now, we know that it was worth it. But we got rate caps on all the properties that had floating interest rates. And right now, we are really buying assets that qualify for a Fannie or a Freddie loan. So agency. The last property that we acquired was 5.15 fixed interest rate, but with Fannie and Freddie, um, the loan to value, if the property is worth $100,000, they'll only lend $60,000. The difference, the other 40 and whatever else, the closing costs and everything that has to be raised from investors. For a bridge loan, for a $100,000 property, bridge loan can go all the way up to 80,000. They can lend 80,000. So that's the difference with agency loans. We have to raise more capital from more um, limited partners. So that's what we're
Yeah,
doing to mitigate risk.
mitigate risk. Yeah, I think that's important. It's good that you have those interest rate caps, the weight caps. So, like you said, your risk is limited. Where even if rates are constantly increasing, you have pretty much a maximum on that particular property. And I think what you mentioned about the government agency properties with I believe you said Fannie, Freddie. I believe you said that definitely probably helps as well. So that's good that you all are positioning yourself in this current environment. And I also wanted to kind of talk on just some of the tax advantages when it comes to syndications. I do want a headline here that we're not tax professionals, but with just kind of doing reading on these different concepts, it's under my impression that partnerships are not taxed, but rather the IRS, they look at them as pass-through entities, where the income of the partnership is passed to the individuals, and as a result, only these individuals are taxed on the revenues and not the entity itself. So I was wondering if you could kind of just briefly touch on some of the tax advantages that you see as a real estate investor within a multifamily space.
So, like Kevin mentioned, we're not CPAs, but my 2 cents on that is with real estate, with commercial real estate, there is something called cost segregation, which takes into account depreciation of the property, meaning the asset is getting older and the things that need to be replaced, like carpets and cabinets and whatever else that depreciate, the IRS lets us take those as front load all of it and get it as depreciation on a property. Those are not real losses, and it's the property is actually not depreciating, it's just getting older. But now if you're paying attention to the real estate market, just because a property gets older, it doesn't lose its value. If anything, the properties are gaining value. Um, so because we are providing value, meaning we are providing housing to people that cannot afford or don't want to afford a house. Millennials are not buying houses, as many houses as baby boomers or previous generations did. So because we are providing value to the general public, IRS lets us take depreciation. It's not a loss, but it's a paper loss. On paper, if you invested $100,000, um, Schedule K1, which is the tax form that partnerships generate to the limited partners, is just like a W-2. If you work for an employer, you get a W-2, and if you invest in a syndication, you get a Schedule K1. And on that Schedule K1, you will have the depreciation mentioned on there, how much your initial contribution was, meaning how much your initial investment was, and what the distribution was. And in high level, passive income and active income are completely two different buckets, the way IRS sees it. Um, Active and passive, if you're trading your time for money, that's active. If you're invested your money and your money is making more money, that is passive. So depreciation cannot offset active income if all you do is if you have a job, if you have a W-2, and you're investing in syndications, you're most probably not a real estate professional. there is a higher level IRS status called real estate professional status. And a lot of people that are actively in real estate may not even qualify for it, but it's a high bar to reach. But if this, we're just talking to limited partners, um, the money you're going to make from the syndication will offset the depreciation because it's passive income to you. And you'll offset the depreciation will offset the passive income, but not for the active income. So the tax advantages are a little bit limited, but show me another asset where you will get um, depreciation and your gains are offset. If you make the same amount of money in the stock market, and if it's a short-term gain, if you buy something and sell it within the year, you lose a lot of that money because IRS tax it at a higher tax bracket if it's short-term. So even if it's long-term, even if you bought something in a stock and sold it after a year, it's still long-term capital gains. Nothing can offset that unless you're a real estate professional. But for limited partners, passive income and passive losses offset each other. So, but
Yeah,
please talk to your CPA. Every situation is different. So,
yeah, that is true, and I think that is the beautiful thing about real estate. I like how you said with the depreciation and the passive income, almost you can offset the passive income and the passive losses, and the comparison to the stock market is spot on. Even if it's short term or long term capital gains taxes, you still are you're going to have those taxes that you're going to have to pay. But in real estate, it could be a little bit different with passive income. So I think that that is, definitely good. And yeah, kind of like what we're saying, definitely make sure that you kind of sit with a CPA to understand your own tax situation. But as we're coming to a close here, Deepa, if you could kind of share with the audience how they can connect more with you on LinkedIn, and also if they do want to invest with your real estate company, Vinside Capital, how can they go online and learn more about the work that you're doing?
oh yeah. So I am active on LinkedIn. My full name is Deepa Reddy Akula, and I have a PE and MSME and a bunch of things right next to my name, so you'll find it if you type in Deepa Reddy um, on LinkedIn. And if you'd like to contact me and learn more about the properties that we own right now at Winside Capital, please go to winsidecapital.com, and under the portfolio page, you could see the different assets that we currently hold. And if you could put your information on there, I'll get back to you.
Thank you so much, Deepa, for sharing that. And I'll put all of her information, everyone, in the show notes, so you can be able to contact, reach out to her. She's definitely a friendly person, very knowledgeable within the real estate space. So I definitely would say reach out to her if you have any questions when it comes to wanting to invest within this industry. But Deepa, I appreciate your time so much to be doing this. I know you're on Pacific Standard Time, so it's probably like 7 o'clock there right now. So I thank you so much again. I really enjoyed talking with you.
Thanks, Kevin. It was such an honor. I really loved it to be on the show. Thank you for the
Thank
opportunity.
you. Oh, thank you so much. And thank you everyone for listening and watching, and take care.